back with our featured guest, Kash Pashootan. He's going to zero in on the Bank of Canada and when it may cut rates, and by extension, the Fed as well, and what this difference between the two banks means to investors. The Bank of Canada widely expected Kash to cut at least by July, if not in a couple of weeks, on June the 5th.
Yeah, I think we're at this interesting juncture in the road. As Canadians, we often compare Canada to the U.S., and there's similarities most of the time. And we're entering a period where we think actually that will be different, and we will see a divergence in monetary policy between what Bank of Canada is going to do, Paul, and the Fed. And that's laid out even as early as this year. So as you mentioned, high probability of Bank of Canada will cut rates by July, and even in fact earlier. And that expectation is around a quarter point by July. And in fact, like I said, probably more like in June. And then depending on sort of what you're looking at, we're seeing estimates anywhere from another quarter point all the way to 3/4 points from some of the more sort of bullish economists and reports by the end of the year. So a quarter plus another quarter is half, up to 3/4. So this year, we expect to see rates come down in Canada anywhere between 0.5% and 1%. How does that compare to the U.S.? Very different story. There's almost a zero probability of a rate cut in June in the U.S., and a very, very low probability cut in July. So it's not expected that the U.S. will even look at cutting rates until later this year, and the expectation today is about a quarter point by the end of this year. So if we have half to a full point cut in Canada this year and only a quarter point cut in the U.S., quite a divergence. And so as investors, we should be asking ourselves, what does that mean for the portfolio? And I would say that there's a few implications that we should be talking about.
So let's begin with the so-called interest rate sensitive stocks.
Yeah, so I think one thing I would say before we even get into the interest-sensitive stocks is that as investors, if you own U.S. stocks, the currency is going to actually have a fairly meaningful implication if this divergence plays out. So as rates come down, generally the currency of that country also weakens, and as rates go up, the currency strengthens. So if we have a scenario where Canada is cutting more than the U.S., you can expect to see the U.S. dollar strengthen. And for Canadian investors that own U.S. stocks, whether it's directly through an ETF or a mutual fund, there's an opportunity here to actually benefit or profit from the U.S. dollar strengthening. And in order for that to happen, you have to take a look at your portfolio and make sure that the currency is not hedged. If your currency exposure to the U.S. is not hedged and the U.S. dollar strengthens, you stand to benefit from that. And what's interesting is sometimes you actually make more money on the FX than you do in the underlying stocks going up. So that's one implication or consideration that investors should be looking at as they're thinking about their portfolio. And then, as you mentioned, the interest rate sensitive, of course, are also another consideration. We've had these bank stocks, utilities, telecoms really sell off as rates went up. We do expect them to benefit as rates go down, because now that risk-free rate of return is lower, and so the dividends that you're generating from those types of stocks are more attractive.
If money moves into those stocks, where does it move out of?
Yeah, so we see it coming out of exactly what's benefited the last sort of 18 months, which would be the defensive stocks. So something like the healthcare stocks, for example, they've really ran up, and they have been a great place to be as rates have gone up, but we do expect some downside pressure on those share prices. So not a bad time to be looking at your portfolio and weighing how much one has in defensive stocks relative to dividend stocks. Now, keep in mind, some of this is priced in, but we are still in the early stages. So investors have an opportunity to do some rebalancing here and position themselves well for rates coming down.